Hey, Steve Saretsky here. As always, Canadian real estate market update, the particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I'm going to do a video in the next couple days on an update for the Vancouver housing market for you original subscribers who want that content. Just a quick little preview. January through to the end of September, that 9-month period, we just hit a record where during that 9-month window, Greater Vancouver has seen the highest number of sales of any 9-month period in our history. So that's the current status of the housing market, but we'll get into that in a later video. What I want to touch on in this week's video is back to the bigger picture. And again, whether you're in Vancouver or you're anywhere else in the world, this is going to influence your everyday life. And so I always say that for every action, there is a reaction, right? So everybody just thinks that, we got through this pandemic, scot-free, so to speak, that there are no ramifications. And I think that we're now starting to see that is completely false. One of the things that we're seeing is that when governments back at the onset of the pandemic, in March and April, the idea was, okay, the economy is going to go into a free fall. This is going to be Great Depression 2.0. So what did they do? And probably rightfully so, they hit Control P. So they printed the money and handed it out to households and businesses. And so we kind of staved off this huge drop in demand. However, the supply chains were disrupted. Supply actually, I think thought that demand was going to falter and obviously shut off a whole bunch of those supply chains, but also with COVID, ultimately trying to stop and start global supply chains is not a simple task. And I think ultimately everybody is well aware that demand is probably a lot higher and stronger than anybody anticipated because of all the central bank and government money creation. And so we're now in a situation where you've got this weakness in supply chains. You've got too much demand that, we're now obviously seeing these inflationary pressures. And this is something that even finally, after to much chagrin, we had the head of the Fed, USJ Powell, come out and say that inflation is in fact frustrating. So let's clip to that video right here.
So I guess I'll start by noting that the outlook, while I think quite positive in the medium term, is highly uncertain. And one of the main reasons for that is just that this expansion is quite unusual and actually very different from the normal pattern. So what we have now is very strong demand, quite strong demand on the back of strong fiscal policy, strong monetary policy. In the United States, fiscal policy more than fully replaced lost incomes. So typically at this phase of an expansion, we'd be supporting aggregate demand with our monetary policy to try to get back to a full level of economic activity. And that's not the situation now. Demand is strong. It's supply side constraints that are really holding back the economy at this time. So quite unusual. And I guess Christine mentioned, the demand is really in the goods sector rather than the services sector. So usually the services sector would be okay in a downturn and goods would be sharply cyclical. We have the opposite. So the playbook for what to do and how to think about this is quite unusual. Turning to the United States for just briefly, very strong demand with the support I mentioned. Household and business balance sheets quite strong. Demand in the first half and results really strong. A lot of people getting back to work. Over the last couple of months, the Delta variant has held up progress, keeping people from resuming public activities in the travel and leisure sector. Job growth slowed sharply, and estimates of third quarter GDP have come down, albeit still to strong levels. Bottlenecks and tangled supply lines are holding back activity in some goods, particularly automotive. And the combination of strong demand for goods and the bottlenecks has meant that inflation is running well above target. And we expect that it will continue to do so in coming months before moderating as bottlenecks ease. So the outlook, as I mentioned, is for strong demand to return as Delta cases continue to decline, bringing faster progress toward full employment. It is frustrating to acknowledge that getting people vaccinated and getting Delta under control 18 months later still remains the most important economic policy that we have. And it's also frustrating to see the bottlenecks and supply chain problems not getting better. In fact, at the margin, apparently getting a little bit worse. And that's what has we see that continuing into next year probably, and holding inflation up longer than we had thought. But ultimately, the outlook for next year among my colleagues and me at the Fed for next year is quite a strong year with growth well above trend and unemployment reaching significantly lower levels than now. Thank you.
So the reality is that inflation is going to persist for a longer time, and we're seeing this across all these different sectors and segments. Is that all we have to do is look at, for example, one of these ones I look at, found it interesting coming out this past week. It was, Dollar Tree, which sells everything for $1, saying, hey, on a whole bunch of our products, we're now going to, raise prices upwards of $1.50. And, this is a company that's built their entire brand. And like, once Dollar Tree raises prices to $1.50, I can assure you in a year from now, they won't be dropping those prices back down to 99 cents. So, these things that they're calling, transitory, I think are actually in large part going to be structural. But you can see that the dilemma that the central bankers are in, right? So you've got a situation where, inflation is running hot. And so what are they supposed to do? Are they supposed to hike interest rates to quell this inflation when a large part of this inflation is in fact from basically broken supply chains that are struggling to get back up on their feet, and there's just too much demand. And so I struggle to see how Jay Powell hiking rates by 50 basis points is going to all of a sudden fix these supply chain issues. And so they're on this very odd predicament of inflation is going to be persistently higher for the near term foreseeable future. So if you're looking into these issues a little bit further, one of the supply side destructions that we've seen is in the oil and gas sector, right? I mean, they saw the pandemic, there was clearly a demand hit there, and so supply and capex into that oil and gas sector has been decimated. And furthermore, you've got all these governments coming out with these ESG mandates, which is great. Sure, it's well intentioned, but at the end of the day, if you starve that industry of capital, you're going to run into what we're seeing now is ultimately an energy crisis, because the renewable segment, the renewables, this green movement is not ready to replace these fossil fuels, and so all you have to do is we're seeing the headlines now where, for example, in Europe, gas prices hitting record highs. I mean, it's going to be a long, cold winter in Europe and for much of the world, right? And so, gas prices hitting all-time highs. You've got the Chinese government telling, major businesses and corporations to secure, their oil prices, to secure their oil and gas at any cost necessary. And so what's actually happening now in China, for example, is they're shutting down several of these industrial manufacturers. Actually, in fact, Tesla and Apple's manufacturer actually has been shutting down they've been mandated to shut down to essentially preserve energy costs, because they're trying to basically give it to the people, to the citizens. And so they're saying, hey, listen, you guys got to temporarily shut down your production. As if, now, is that going to help or impair supply chains even further? You've already got the chip shortages. Well, now they're having to shut down because there's not enough, cheap energy to go around. And again, so how does the oil and gas sector, how quickly can it get back online and get through all these bottlenecks? So I think this is really important to understand the larger picture of things, and so you've got this issue now where you've got these broken supply chains which are showing no signs of getting better. You've really got what appears to be the early stages, or at least middle stages, of an energy crisis now, where the cost of heating, the cost of fossil fuels pushing higher, which is ultimately going to impair the average day-to-day person's cost of living, right? I mean, if it costs more and more for you to put fuel in your car and to heat your home, that is a crisis, and that crisis, I think, looking forward, appears to only getting worse. So again, it remains very difficult for me to be optimistic or bullish on the middle class for the foreseeable future, because why? We've got, again, really a cost of living crisis that I think are ultimately the ramifications of having a pandemic and having the world shut down, right? We might not have seen it shown up. That crisis didn't show up, for example, in falling asset prices. In fact, it pushed asset prices up by through the Control P method. But what it is doing is ultimately we are paying the consequences now, which I think we're seeing through rising inflation, which is ultimately a tax on the lower and middle income class. That's who really bears the brunt of higher inflation. And so to sort of see Jay Powell come out and say, hey, listen, we can't really solve this through interest rate hikes. And people, there's a great chart that was put out here that, you see all these bond traders and, Wall Street and financial markets think that, the Fed's going to suddenly embark on a normalization of interest rates with, U.S. government debt to GDP sitting at, close to 130%. The last time that debt to GDP levels were at this level, we engaged in, the U.S. engaged in financial repression, basically for 30 years, where the cost in inflation ran higher than bond yields for 30 years. And so to think that this can't be happening again, or it won't happen, to think that you're going to engage on a rate hiking normalization cycle with debt levels where they are at, to me, it's math, and then the math doesn't add up. The math doesn't work. So how do we muddle through this now? I ultimately think that, again, the cost of living crisis is going to be front and center for at least, I think, the next couple of years. It's going to be the largest problem on our hands. And I think that people can certainly feel that. And I think everybody that's watching this video is well aware, regardless of your financial position. So keep that in mind. Educate yourself on the system, what's happening around you. Moving forward, looking at really focused on the cost of living. I just remember, people coming out and saying, hey, oil's dead. Don't invest in Alberta. And again, yeah, it's true. I don't think you're going to see very much CapEx in the oil space moving forward, because it is not appropriate. The governments don't want it and they don't want to allow it. But what does that mean? Your cost of heating, your cost of living standards, in my opinion, are going to fall as a result of that. Again, every action, there's a reaction. And so just like when you hit Control P, there's a reaction in asset prices. Well, if you shut off fossil fuels, which are the dominant source of energy, guess what? Your heating and energy bills and your standard of living are going to change. And so that's kind of what I'm focused on this week. We'll probably get back into the real estate next week. But again, this all matters because it's all part of the same trade at the end of the day. So keep that in mind as we move forward. As always, we'll see you next week.